Right, everyone. This video it's kind of going back to what we did all the way back in theme one, and that is market failure. Okay, now hopefully you remember what a market failure is, but all a market failure is where the price mechanism, the force of supply and demand, don't lead to the best level of output. Okay, so we're basically not at the optimal output point, the social optimum output point. What this means is it's going to lead to problems for people. So without government intervention, the free market will create lots of problems which will impact on people in bad ways, whether it be other firms or whether it be consumers or whether it just be third parties or the economy or the government in general. Now, financial markets are full of market failure. I'm going to go through them in order, but the ones we're going to be looking at are asymmetric information. We're going to be looking at moral hazard. We're going to be looking at speculation, which is often linked to something we call market doubles. We're going to be looking at something we call market rigging. And then finally, externalities, which is the one that you probably all remember from last year, but we'll get there anyway. So we're going to go through them in order. 1, 2, 3, 4, and 5. Okay, so the first one is about asymmetric information. Right, now all asymmetric information it's where in a marketplace, either the buyer or the seller knows more than the other person in the marketplace. So, for example, when I did Year 6 French, French for the first time at school, in my head, for some reason, I thought what the teacher was telling me was nonsense. I thought they were making up their own language. So in that market, she knew more than what I did. So I thought in my head I was getting a raw deal. Now, in financial markets, we have lots of examples of asymmetric information. And it's normally because the person that sells financial assets knows a lot more about them than what the person buying does. So not often, what we often say is that the supplier has got more knowledge than consumer. So in other words, the person selling you something knows more than what you do. Now there are examples of markets where it's the other way around. So for example, when I took out my life insurance quite recently, I lied about my weight, I lied about how much I drank, to make me look a bit healthier to reduce the premium, reduce the cost. But that could lead to me getting an insurance deal which is better than what it should be, if you like. But quite often in financial markets, the person selling you the asset knows more than what you do. I suppose that the best example in recent times is the PPI stuff, payment protection insurance. So what happened was, for years, this was at the end of the 1990s, early 2000s, people were offered payment protection insurance on loans, mortgages and credit cards that they took. And this basically meant that if people were to lose their jobs, then this payment protection insurance would kick in and their loans would still get repaid, so they wouldn't be defaulting on their debt. The trouble is, the banks often didn't check that the people that took it out actually needed it, if it was actually appropriate for them or not. So a lot of people were missold PPI, took out these expensive payment protection insurance policies that they didn't really need, or that they couldn't really benefit from. People often also paid a heck of a lot more for them than what they could have done if they'd shopped around and looked elsewhere for it. So it meant that people were buying something that wasn't really benefiting in any kind of way, which now you've got a lot of people trying to claim back their PPI. Well, in that example there, you can clearly see how the consumer is losing out because they lack full information in that marketplace. They're buying something which is not going to raise their economic welfare. Another one is securitization. Now, this was actually asymmetric information between firms. So all the securitization is where you bundle up lots of different assets together, and you're basically creating a big pool of assets which you sell onto something else. So a great example was it ultimately led to one of the big causes of the financial crisis in 2008. Now, a lot of big financial firms, they pull together mortgages, so big blocks of mortgages that people have taken out. And because they're assets that generate, a monthly return when people make their mortgage repayments, they've got a value. So many banks sold these on to other people in financial markets. Other banks, for example, there's big pools or securitized mortgages. And the idea would be because you're bundling lots together, they're reducing the risk. If one mortgage defaults, you've got another where you've got lots more in that big pool that aren't going to default, which means you're going to keep getting some kind of regular income. But what happened was we had the subprime mortgage crisis where lots of people took out mortgages that ultimately would struggle to pay them back if interest rates went up. So within these big securitizations that people were buying or banks were buying, they thought they were low risk. But within them, they were bundled up. There were lots and lots of toxic assets. There was lots of different mortgages where people were starting to default on their payments. And that basically led to the credit crunch, which ultimately meant that banks didn't want to lend to each other because they were worried about ultimately buying up lots of these toxic assets. And it meant that banks wouldn't lend to each other as well because they were worried that other banks might go bust and they might be able to repay their money. Credit dried up, and it ultimately led to the financial crisis. Another example is with regulators. Well, regulators exist to intervene in markets to make sure that firms are doing what they're meant to be doing, basically. Prices, for example, quality standards. Well, financial institutions have got very little, if no incentive, to tell regulators exactly what's going on. On top of that one as well, big financial firms have got lots of money. They're very good at lobbying government. In other words, fighting with government to get their way. And it often meant that regulators often saw things their way and kind of allowed them to get away with the problems of the PPI scandal, the securitization, for example, and it made them very powerful against the regulators. So because they knew more than what the regulators did, they kind of got away with more than what they should have been. The second type of market failure is something that we call moral hazard. Now, again, this is something that we looked at in AS economics. Moral hazard. Well, what is it? Well, it's basically where you can make decisions that have got risk, but if something bad happens, then you can pass on that problem to somebody else. Okay, so if you wanted an example, imagine you were a big business that employed lots and lots of people. You're really, really important to that local economy. If things start to become bad, you take on big risks, for example. If it pays off, you get lots of profits. If it doesn't pay off, because you're so important to the economy, that the government will probably bail you out. Now, in financial markets, we've got lots of examples of moral hazard. A really good example is linked to investment banks, which naturally are quite risky. They take lots of speculative gains, for example. And a lot of the people that work in investment banks, they're driven by short-term profit. Okay, they ignore long-term risk. So a really good example is, and it's one I've nicked from the textbook, but I really like it. By taking lots of risk, you might work in an investment bank and for the next 5 years, generate for yourself lots of profit for your bank. And that will also mean that you're going to get big rewards, big sort of payouts, for example, bonuses, promotions, all those different things. Let's imagine that enables you to earn £1 million a year. Well, for 5 years, keep doing that, you get £5 million. Then in the 6th year, you bugger up, cost your business a fortune, and you get sacked. Well, so what? You've earned £5 million. If you hadn't been so risky and thought more longer term, you'd have only generated a much lower income. Let's imagine it was £250,000 by playing things safe. So in the 6th year, you wouldn't cost your bank a fortune, but it's going to take you a lot of years earning 250 grand to earn that £5 million. So you're better off taking short-term risks because you can earn lots of quick money, knowing that in the long term, it's your firm which will end up paying the cost of it ultimately anyway. But with investment banks as well, these guys are also naturally very, very risky. investment banks by their nature look for short-term profit. So they take very excessive risks. They take big risks in the economy. But they also know that they're very important to the working of the British economy. So if they fall under big financial problems, then ultimately they know the government will bail them out anyway. So think about that. When things are going well and the risks are paying off, you keep all the profit. If things go bad, you know ultimately that the government will bail you out anyway. So it's kind of encouraging you to take lots of excessive risks. Linked to that one, to a certain extent anyway, you've got speculation, which is often created by something we call market bubbles. Okay, now all a bubble is where the price of an asset is driven sky high by people speculating the price will keep increasing. And when people realise it's not, bang, the price will start to crash. A lot of people say that this is often caused by something that we call herding behaviour. You often find that investors, when they buy different financial assets, whether it be stocks and shares, lending money, for example, commodities, they don't look at the underlying value of the asset. They don't look at what the asset is really worth. They look at what other speculators are doing. So, for example, if lots of people are buying a particular asset and the price is going up, you want a part of that, so you go and buy it, which pushes the price up even more and forces more people to want to buy it as well. But eventually, as you build up that bubble, as the price starts to grow, eventually it's got to pop. The value becomes so expensive that people will sell, and it drives the price back down again. This kind of happened in the UK housing market. Okay, as house prices were growing, lending money people to buy houses became, well, it got seen as a low risk, if you like. So more and more lending was offered to people to buy houses, and that kept pushing house prices up. And because of that, people that lent money out to people to buy a house thought, you know what, we can't lose. We've got all them assets laying around in them houses anyway. If people default, we've got the properties. So house prices kept getting pushed further up. And then you had people that probably couldn't afford to repay mortgages if interest rates would start to grow, to buy houses too. It pushed them up that high that eventually we had to start thinking, what do we do about this? So it could be, for example, that interest rates start to climb to sort of reduce demand for houses. As that happened, you had a lot of people who struggled to repay their mortgages, might default on that mortgage. And as demand fell and house prices fell, a lot of people fell into negative equity, which meant the price they'd paid for their house or the loan they'd taken out for their house was more than the actual property value. It's a bit like buying a house for £150,000, taking out, let's say, £130,000 mortgage, to find a year later the house is only worth 100 grand, but you still owe the best part of 130 grand. And that led to more and more people defaulting. And what this created, because this bubble started to sort of pop, if you like, was a big negative multiplier effect across the economy. It affected confidence, it reduced wealth, it reduced consumer spending, investment started to fall, people lost their jobs, and we ended up in this big, huge recession because of it that we're still paying for now. Another example would be the dot-com boom. Okay, well, in the sort of mid to late 1990s, let's say about 1997 or so, you had something called the dot-com bubble, where people saw the internet as the future and they started to buy stocks and shares in internet companies. And this pushed up the value of internet companies to record highs. But again, the bubble burst and the market collapsed. And again, it had big sort of negative spreads across economies across the world. So again, impacting on people outside that marketplace. Another one is something that we call market rigging. Well, if you rig something, you're trying to fix something. So all market rigging really is where people, so it could be individuals, it could be institutions, collude to fix prices. It could be looking to raise prices, lower prices, whatever it's going to be, just to gain some kind of quick profit at the expense of others. So a really good example is insider trading. Okay, so imagine that you know something about a firm it's got its shares on a stock exchange, and you know that in the next few months that business will announce some really, really great thing they're doing. Well, what you might do with that information that you've got that the market haven't got, you might go and buy that share to make a profit. That could drive up the share price. You're making a profit on the back of others. If you know that firm's going to announce bad things coming up, you might sell that company shares before the market finds out about that information, and that will lead to the share price plummeting. In terms of market rigging, you can also do this to fix price of commodities, currencies, or assets as well. So you're kind of gaining a profit at the expense of others. Okay, so say for example, people start selling a share. That means that everyone's share value starts to fall as the price starts to fall. It's affecting on other people. Now, the one that you're most familiar with is externalities. This is where things happen in the market, good or bad, which will affect third parties in either a good way or a bad way, in other words, people outside that market. Well, let's think about bad things, negative externalities, if you like. Well, the most obvious example, because of what happened in the financial crisis, so, you know, you had all that speculation, we had the bubbles bursting, you had this big negative multiplier effect across the economy. And this cost the government over £1 trillion. What that cost us, people that don't operate inside that market, our hard-earned tax money to deal with this problem. You also had the problems for employment and the recession and loss of incomes, for example, as well. So this affected everyone, even those outside of that particular marketplace. So what you've got there are 5 really important market failures that exist in financial markets.